Welcome to the deep dive video update. This is a weekly video where I go through some of the charts that I didn't use all that much in the daily videos. And the list is quite a bit shorter this week because of a lot of things happening in the market. Some of the charts that I show just in this video, I've actually been using in the daily videos. There are also some additional charts that are unique just to this video. This is being prepared for Monday, March 10th. The first chart is just for information. It's showing that overall we're in a lower range for the VIX, and even though on the daily charts we're well above 20, we have been going up with the moving average here, but we're still in a lower range overall. Also, this is the VIX and then a correlation with the S&P. Still getting really low readings right now. I only use this chart if we go above the dash line, but we've been getting a lot of good information from the VIX itself and not really any additional insight from this chart. Then we look at the VIX and then the VVIX, which is like an indicator of the VIX to measure how volatile is the VIX itself. And it's going up as stocks have been under pressure lately. And so we're seeing an increase here, but we've really been range bound now for the last couple of years. We're not seeing any real conviction, real big up moves or down moves right now. Now, this could change. And if this continues to go up, that will show that the market is probably getting more negative. Now, for the first time in a long time, I get to put this chart back in the deep dive video. I have been using it in the daily videos for last couple of months. This is a variation of the VIX. It's called the SKEW Index, or the VIX uses at the money options, whatever the at the money is at that time to do its calculation. The SKEW looks at out of the money options, either above current price or below current price of the S&P 500 to do its calculation. And when we get up into this red area, it just means there's a lot of out of the money options that are being traded, and we get a very high reading here. Well, there's call options and put options, and calls go up in value as the market goes up. Puts go up in value if the market goes down. So sometimes it's hard to interpret, okay, is the market expecting an up move or a down move? We finally dropped out of this as the market's been coming down. And so we're not getting an extreme reading right now. Doesn't mean that a big move won't happen. It's just, according to this chart, it's not seeing that big move currently. Then we look at the volatility of stocks as measured by the VIX, and the volatility of bonds is measured by the move index and do a ratio. And the red line, which is what I follow the most, it's going up as we're seeing more volatility coming into the market as the S&P has been under pressure. And this is for informational purposes, just to get some ideas of where are we from the October 2022 low. Even though we've been pulling back, we're still up 65.12% from that low. We set another low in October of 2023, and we're still up 40% from that low. Then stockcharts.com has a thing called technical alerts, and I go through these in the daily video, but this is for the whole week. And really, it's hard to read because it's very small, but I just look at the color. If we're seeing a lot of red, that means things are negative. If we're seeing blue or green, that means things are more positive. And this was a difficult week for the market, so we're seeing an awful lot of red here. Then another thing is I look at 6 indexes. I used to look at 5, but I included just the NASDAQ itself. And stockcharts.com rates them on a scale of 0 to 100. The higher the score, the better looking that chart from a technical analysis perspective. Now, this tool from stockcharts.com, it can be used on a stock, it can be used on an index, on a sector. I use them on indexes here. And then I rank them from top to bottom. Which index is looking the best right now? None of them are looking all that good, but coming in first place this week is the Dow. This is the Diamonds, which is the ETF for the Dow. And when we're really strong, we'll get scores up into the 90s. I look for high 80s, low 90s as a good technical score. Well, first place this week is the Dow, which hasn't been doing all that great, but it's been holding up better than other indexes as we've been going down. So it's coming in first place now at 56.3. In second place is the S&P 500, and that's where I focus everything. Now, it's holding up a little bit better because there is value. We're seeing this shift from growth over to value, which that's what the market does when it gets more defensive and getting ready to go down. But we've been here before, and we've been able to switch back and see growth take the lead. But pretty much since the beginning of December and then going into 2025, the market has been really confused with all these tariffs, all these changes, all the executive orders, all the things that are going on politically. And there are geopolitical events as well. And it's really producing some confusion right now. Well, when that happens and the market becomes more defensive, they tend to switch out of growth stocks and get into value stocks. And then there's a lot of value in the S&P 500. And so that's why it's not looking great and it's in a downtrend in the short and intermediate term, but we're still coming in second place with a score of 40.7. Then in third place are the big tech stocks. This is the NASDAQ 100, and it's coming in at 33.5. Then we have the NASDAQ itself, which has actually been outperforming the NASDAQ 100. Well, lately, you can see how the score has really been coming down here. It's coming in with a score of 25.3. Then we have the mid caps, not really looking very good right now, coming in at 14.2. And then this is not very good at all. These are the small caps, and they're coming in at 6.5. All right, a short-term rainbow goes from 10 periods up to 50 periods with a simple moving average, and I changed the color so it makes it look a little interesting here. But for a lot of 2024, we were well above this rainbow and the rainbow was going up. Well, we're dropping below the rainbow on a short-term basis. And this is why we're in a short-term downtrend. I measure the short term by a 20 period moving average. And some people use a 21 day, a 17 day. You can use whatever moving average you want. I just settled on a 20 period. And then I put one moving average below that and then a number of them above it. And you can kind of see the flow of the lines. If we're in a solid uptrend, the lines are flowing up. If we're in a downtrend, the lines are flowing down. We're really choppy right now, and we're wondering, are we getting ready to shift to a more negative environment? Then we look at the advanced decline ratio. Now, I show a chart of this in every daily video, which just focuses on the top part, which is price. And we're below zero. And we did drop below zero, but now after Friday, with the slight update that we had, we were up a little over 0.5%. We are actually crossing back above zero. Now, it's kind of interesting that we've been going down with the S&P, and this has actually been holding up fairly well. That also could suggest that money is coming out of growth stocks, so that would be the negative part of this reading, and it's going into value stocks, which would be the positive part of this reading. And so that's why it's kind of holding up around the zero line right now. We did improve in Friday's session based on volume, and that's the additional part that's included in this chart that I don't have on the chart that I usually show in the daily video. But we're still below zero here, even though it did bounce up a little bit. Intermediate term, another rainbow. This looks at a 50 period moving average up to a 100 period moving average. And now we're seeing where the intermediate term is more vulnerable at this point. The lines are slower, and so they don't roll over as fast, but we are bunching up here. The longer we stay down here, the more these lines are going to roll over and look even more negative. Then this is an oscillator very similar to the RSI. It's the Connors RSI. And on a day in and day out basis, this thing really moves, but it doesn't give us extreme positive or negative readings all that often. It's not giving us one now. And I only show this in the daily video if we're above the black line on top or below the black line on the bottom. CMB composite is actually going up. And now I did show this in late February when we were getting an extreme negative reading. I also use this like an oscillator, looking for extreme positive or negative readings. And this is more short to intermediate term, but it's actually been improving a little bit, but not giving us an extreme reading currently. So I haven't been using this in the video. I did use this a couple of times recently, the Bollinger Bands, and as I usually say, there are books written about how you can use and implement Bollinger Bands. This is just one implementation of them. And this is the percent B indicator because we've been coming down And there have been times when we've actually closed outside of the lower Bollinger Band, and that means we're moving down pretty far, pretty fast. Other times when we're really moving up, we may close outside of the upper Bollinger Band. Well, we're not doing that now. That's what the percent B measures. We are negative because we're below the midpoint, but we're not giving an extreme reading currently. Then we keep an eye on the S&P 100, which in a good solid market, it will outperform the S&P 500, even though their charts look pretty much the same. And that's what I'm looking at here. Any kind of real divergences from each other. We're not really seeing that right now. But the S&P 100 is now starting to underperform the S&P 500 in the short term and even somewhat in the intermediate term. And we look at a ratio between these two indexes, and it's actually starting to have a downtrend when compared to the S&P 500, which just means the big stocks, the large cap stocks in the S&P 100 are underperforming. A long-term rainbow goes from 50 periods up to 250 periods. This has happened pretty fast with this decline, so we're not seeing the lines rolling over as much now, but we are coming down into the rainbow, and the longer we stay in here, the more these lines will jumble up, and if we actually fall below the rainbow, that would mean that the long-term trend is either turning negative or in the process of being vulnerable and actually negative at that time. Then this is a long-term oscillator that we don't get many signals from. The signal is when we cross above or below the red line. Even though we're coming down with the special K, we're still above the red line. So I'll keep an eye on this, and if we cross below, that could be a long-term shift over looking more negative. And then this comes and goes out of the daily video, but I haven't been showing it because this has actually been holding up fairly well, which might suggest this idea that we're going from growth into value. It's not like money's coming out of the stock market. It's just going from one place in the S&P to another place. And so when we look at the 10-day average of the highs and lows for the S&P, it's holding up okay. It's been seeing some weakness, but we're above 50, so it's still taken as positive. And we keep an eye on European markets, and you can see the German DAX, which is overall, it has really big up days and then some down days, but it's been holding up better. We look at the S&P, which has been coming down, and then you can see how the German DAX has really been going up to the point where we're seeing this correlation actually wearing off. So European stocks in general and in Germany in particular have been stronger lately than US stocks. And some support and resistance. I usually only show this chart when we're dealing with this little mini rainbow here. This is a 20 period simple moving average of the open, high, low, and close. We're well below the rainbow, and the rainbow's coming down. Now, even though this is short term based on 20 periods, I found that this rainbow actually works pretty well for the intermediate term. When we're going up and then we pull back, one of these lines will often act as support. When we're going down and then bouncing, one of these lines may act as resistance. Well, we've been going down pretty quickly here, and we're not even near any of these lines right now. The takeaway is that the rainbow is turning over and actually going down. If we start to bounce back up and get close to some of these lines, then I'll start to use this in the daily video again. And looking at the broad market, I mainly focus on the VIX, which is the volatility of the S&P 500. This is the VIXen, which is the volatility of the NASDAQ 100. I focus on the line chart down here. You can see there's a lot of really crazy data lines here. It looks like icicles off a roof. But we're seeing a real pickup in volatility right now. But I do so much analysis on the S&P 500. I just look at this chart where I use the VIX for the S&P 500 where I do most of the analysis. Then we look at the S&P 500 on top, and then what's supposed to be represented in the middle are the QQQs, that's growth, that's the NASDAQ 100, and then the diamonds, which is the Dow, and that's supposed to be more value, the best of the best stocks. And we're seeing that the correlation between the ratio in the middle and the S&P is still pretty strong right here. Not really getting a lot of insight from this, but we're just looking for times when we see the correlation really get out of line. We keep an eye on the Dow and the transports. The black line is the Dow, which has been coming down lately, but still holding up better than the other indexes. And the red line are the transports, and they've been under pressure lately too. As a general rule, even though they're on different scales, when the red line is above the black line, that means the transports are outperforming. Well, they've been underperforming now for quite some time. And if you look at the transport index itself, it's pretty much going sideways. And we look at the financial sector. We want to keep an eye on that because that's gave us some clues, not really over a long period of time, but it did give us some clues as we were going into the great financial crisis back in 2008. Well, I look at the financial sector, I look at the bank ETF, which I've been showing in the daily videos because it's testing its 200-day moving average. And then we look at this ratio here, which is turning more negative. These are regional banks, so they're smaller banks in a ratio with the financial sector itself. Now, the financial sector has been under pressure, but for this ratio to go down, that means the regional banks are going down even more. And so we're keeping an eye on that. It's a little bit of a concern here. We're starting to go in a downtrend with this ratio because of interest rates and like Silicon Valley Bank, Republic Bank, New York Community Bank. There's a lot of banks out there that could be vulnerable, and we haven't been hearing about that in the news, but I try to keep an eye on these things anyway. And if some problems develop, we might see a little bit of a heads up here with charts like this. And rate of change charts I just use for information. This goes back 250 periods, so it's a long term chart and we're coming down. So we're still positive with the long-term trend, but we've been testing the 200-day moving average. So it can't help but so far in 2025 to see this rate of change chart going down. We're also declining here below this blue line. Now, when we were really strong, we saw this above the blue line. But sometimes when we get to this blue line or above, that means maybe we've overdone it in the long term. It turned out to be the case this time, and we are pulling down. But the fact that this is going down just suggests that the long-term trend, it's not negative, but it is under some pressure currently. And we keep an eye on bonds and we try to look for the context of this chart. This is cash, 1 to 3 month T-bills. And then we do a ratio with 3 to 7 year bonds where you're tying your money up for a period of time. In a general sense, when this is going up, that means there's uncertainty about inflation and uncertainty about interest rates. And we've been coming down with this. Now, we were getting a little bit concerned here because this was giving us a high reading, but lately this has been dropping off. Yes, there are inflation fears in the market, but in some of our charts, we're not seeing that. In other charts, yeah, we are seeing some problems, and interest rates had really been going up, but lately they've been coming down even though they bounced back up in the past week. So this just shows kind of a stabilizing effect right now. But the longer we stay down here, the more this line will roll over and actually go down. And that would be more positive if we actually see this ratio going down, which is what it's been doing lately. It's more friendly for inflation and interest rates, which stocks tend to like. And we're seeing a little bit of a pullback here with tips. Now, these are Treasury inflation protected securities. These are what folks get into when they're worried about interest rates going up and inflation going up. And they tend to outperform bonds because bonds have a fixed rate where tips can adjust. Well, we were seeing some concern here that the tips were outperforming 3 to 7 year bonds, but lately that has been pulling back. And this is that same thing, but looking longer term tips to 7 to 10 years. This going up, yeah, the market was getting concerned about inflation and interest rates, but lately it's been coming back down. And we look at the long-term bond ETF and then do a correlation with the S&P 500. Both have been under pressure lately, but when we look at the short-term correlation, it's actually getting weaker. We look at the long-term correlation has been getting weaker. The short-term correlation is getting a little bit stronger, but it's right about neutral currently. And we look at the relationship between the long-term bond and the QQQs, the NASDAQ 100. This is also down around neutral right now. Then this is kind of an interesting study that we're not getting a lot of additional insight from here currently. We take the 10-year yield and subtract the German 10-year yield, which gives us this chart on top. And then we plot the US dollar index and we can see that there's a pretty high correlation between the two, which is kind of interesting. It just shows the interplay between currencies and interest rates. When we really pay attention to this chart is if we come down into this red area. That means something's out of line. Well, we're not seeing that right now, even though this has been coming down slightly. We want to keep an eye on the 2-year Treasury yield. Those are shorter term rates. And we've been chopping around quite a bit. And there are sometimes when I use this chart heavily. Lately, I haven't been using it all that much. We're not really seeing an awful lot of conviction, just little up moves or little down moves. And just to compare what's going on in Europe with what we're seeing here in the US, the Eurozone ETF, that's really been outperforming 3 to 7 year bonds. So it just shows that Europe has been strong lately. Then possible positive scenarios. And I've been using some additional charts that I typically show in this video, in the daily video, but these are just to give us some ideas of, are we hitting some kind of a bottom that we can come up out of? Well, we look at the S&P 500 and those stocks above their 50-day moving average. And the takeaway from this is that we're below 50. So that's more negative in the intermediate term. That's the 50-period moving average. Now, I also use this chart like an oscillator when we get an extreme positive or negative reading, which we're not getting right now. But it's then I use this to say, are we above or below 50? And since we're below 50, that's more negative. We do that same thing with the mid caps where you can see we're well below 50 and declining. And then with the small caps, even lower below 50 and declining. So thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.